Welcome to Season 10 of Talking with Traders as we begin 2025. We're into the fifth year of this podcast that began in 2020, and we've just surpassed 200,000 downloads of Talking with Traders. Once again, IG have come on board as the sponsor of this podcast. We're truly grateful to have such a global leader in online trading as our sponsors. In the coming weeks, I'll be interviewing various guests from around the globe on the topic of trading. Some of these will be past guests that we welcome back to the show, and some will be new guests. The idea is to attract a broad spectrum of different perspectives from players in various areas of the markets. None of what you hear here is financial advice, but it is intended to get you thinking about how you might be able to apply what you hear here to your own trading and investing. Remember to subscribe to this podcast on your favorite podcast app. That way, you'll be notified when new episodes are released. Or if you watch these interviews on YouTube, please subscribe to our YouTube channel and give us a thumbs up and leave a comment if you wish. We welcome the engagement. Once again, thank you to IG for sponsoring this podcast into its fifth year, and thank you, listeners, for your continued support. Now, let's get into this week's interview. Hi everyone, this is Garth Mackenzie from Talking with Traders. For this week's episode of the podcast, I'm actually going to be doing something a little bit different. Unfortunately, I've been let down by a number of guests who would have liked to have appeared on the podcast this week. And that's understandable because the markets are very volatile and a lot of them are busy with more important things right now than speaking on a podcast such as this. We try and keep the content here relatively evergreen, and a lot of cases I think they would see this as something that's it can be done at any time. It doesn't have to be done right now while the market is busy flicking around quite violently and quite volatile. So with that, I'm going to actually just give you some of my thoughts this week in terms of where I'm seeing things in the market. And then at the end, some lessons and basically what I'm doing with my own capital in this market environment, how I'm trying to navigate it, because these are scary times for many investors, and try and give you some lessons and some pointers in terms of the way I'm seeing things right now. So up on the screen in front of you is a chart of the S&P 500. It's a weekly chart going back over the last 5 years or so. And what is particularly notable right now is the fact that the price of the S&P 500 has pulled back almost 20%. It didn't quite get back to 20%, but intraday it did. And there's this technical definition that a pullback of 20% is a bear market. Now, I personally think those definitions are all a bit random and a bit meaningless, quite honestly. If a market pulls back 19.5%, is that not a bear market? So I take that with a grain of salt. To me, a bear market is rather a type of market. It's a type of market that's making lower lows and lower highs for an extended period, and it gradually grinds people down. That to me is a bear market. And a bull market, of course, is the opposite. It just goes up and continues to make higher lows and higher highs. Having said that, though, if we look at this S&P 500 chart, what is interesting and notable, really, I think, is that the market pulled back perfectly to that level where the 2021 high came in. And that's at 4,800. Now, keep in mind, the S&P peaked in February of this year at 6,150. So this has been a very, very rapid decline that we've seen over the last couple of weeks. And of course, that's all come about following Donald Trump's announcement of tariffs and all the flip-flopping that he's done around tariffs and the uncertainty that he's created in terms of trade policy. And of course, that translates into uncertainty for business leaders, uncertainty for anybody to plan, hits revenues, hits profits, and hits confidence. And that's what we've seen in the market. But it is notable that we had a pretty meaningful bounce off that 4,800 level. And in fact, right now, as I'm recording this, we're sitting at about 5,400. So we've already bounced 600 points off the low. The question on anybody's mind, I guess, is whether that was it. Is that the end of this pullback? And do we bounce and continue higher from here? Or do we continue to dribble along sideways to volatile? And my sense is it's probably the latter. I think we've seen the peak in this market for quite some time now, and you're likely to see ongoing volatility in the months ahead. Whether or not we actually go back to that 4,800 low and retest it, I don't know. It's possible. Sometimes with these bear markets, you do find a retest of the low after a fairly big bounce like we've just seen. So it remains to be seen. I don't have all the answers, but I'm going to give you some fodder to think about while we're talking about this. The S&P 500 drawdowns is shown on this chart here. And what it really does is it shows you the extent of a pullback in the market from a high to a low. And obviously, you've had some very, very big drawdowns over time. 2008 was the biggest one. That was the financial crisis, and we saw the S&P 500 dropping almost 60% at that time, and that was a very, very deep pullback. Prior to that, we had the dot-com bubble in 2001 that burst, and at that stage, the market pulled back almost 50%. And then if you go back further, you get the 1987 crash, there's 1974 and 75, there was some weakness there. Most recently, we had COVID, where the market dropped about 35% from the high to the low, but made a very, very swift recovery. And then in 2022, we had a bear market, which dropped about 25% from the high before it recovered. Now we've pulled back just shy of 20%. Now, looking at this chart, you can see that that's not unusual. And in fact, if you do the numbers, you'll go back in history and you see that on average, every year has a pullback of an average of 14%. That's not to say every year has a pullback, though. That's the average. So some years will have these massive drawdowns like we saw in 2008 and 2001. And then other years won't have a drawdown at all. For example, in the years between 2010 and up to 2014, the market didn't draw down at all, so that's an average. An average pullback is 14% from the high. So what we've just seen now is nothing unusual really in terms of longer term market volatility. This chart that I've got up here now is the S&P 500, and it looks at the S&P overlaid with the VIX at the bottom. Now, the VIX is the volatility index. That is what options traders use to price S&P 500 options on the Chicago Board Options Exchange. And the higher the volatility reading, the higher the market nervousness typically. It's often referred to as Wall Street's fear gauge. So high volatility is an indication of high levels of fear. But it's also often used as a contrarian indicator in a sense. And if you have a look at this longer term chart, this goes back 20 years now, but I've highlighted a number of areas here on the chart where the VIX has spiked. And notice how in most of those cases that VIX spike has been pretty much exactly at the same time as where the market has bottomed. So that's where it becomes interesting as a contrarian indicator. Now, in this latest pullback, we saw the VIX spiking to about 45. It actually reached a high of 60 during the day last week, which was a very, very high reading, but it didn't stay there. So by the close, it closed at about 45. But if you go back in the past and you look at any time really where the VIX has been above 30 or above 35, those typically have come about at times where the market has been at a bottom. It's the time where the panic has been the loudest and the volatility has exploded, but that has also been the time where the market has pretty much seen the low. And if you were brave in those moments, that was actually a great time to get involved in the market. But that's also the time when you see the most amount of capital changing hands, from the weak hands to the strong hands. There's a saying that in bear markets, shares return to their rightful owners. And that's kind of what you see in these situations where the VIX spikes. It's a huge panic on the one hand, but it's also huge opportunity on the other hand for those that have a cool head and are able to take advantage of that move to the downside. So if we just highlight the ones that I've looked at here, back in 2008, you can see the VIX spiked aggressively then, and that obviously was where the market bottomed in early 2009 actually. That was a particularly violent bear market, certainly the worst that I've ever seen in my career. Then in late 2011, there was a European debt crisis and volatility spiked at that point. But that also coincided with a period where the S&P 500 bottomed. It didn't make a V bottom at that stage. It bounced along a little bit and was quite volatile for a number of months, but ultimately it rallied out of that oversold condition. Back in late 2018, there was also a major dip in the market at that point. In 2020, we know what happened there. That was with COVID. And of course, at that stage, the volatility index spiked up to, it actually got as high as 80 intraday, but it, on a closing basis, it got to about 65, which was more or less comparative with what we saw in the financial crisis. But of course, again, that time around, volatility spiked exactly at the bottom in the market. And now we get to where we are at the moment, where volatility spiked to 45 last week. As I said, it spiked to 60 during the week in intraday basis. But the market has also potentially made a bottom. Now, I don't know whether it is the bottom. It's a possibility because, like I said, S&P at 4,800 was quite a big support level. But do we just bounce from here, or do we continue to bumble along sideways or volatile? And my own inclination is to think that it's probably going to be something a bit like 2022, where the market it won't go back to the high anytime soon. We may bumble along and maybe even drift a little bit lower to sideways, and it's quite possible that we maybe do go and revisit those lows. There's a number of charts that I want to look at which might help in guiding my thinking here. So this is the US markets as a percentage of global market capitalization. It's a chart that was published by JP Morgan and was widely available on the internet. And what you can see here is that the US percentage of global equity market capitalization has grown and grown and grown over the last 2 decades, really, particularly since the financial crisis. And that's been during very easy monetary condition periods in the US. And you've seen huge, huge growth in the US economy over that time, and consequently, huge, huge growth in market capitalization of shares in the US. But it's become very stretched. And as you can see, leading into this correction that we've just had recently, 67% of global equity market capitalization was in the US. Versus these other regions, Europe, ex the UK, down at 10%, emerging markets broadly down at 10%, and Japan down at 5%. Now, if you start to see a rotation away from the US, which is what we seem to be getting at the moment, where money has been leaving the US to some extent and seeking a home elsewhere in other parts of the world where perhaps trade conditions are a bit more friendly. What that means is that you've got a huge amount of money coming out of the US, making its way into a relatively small door, in the sense that going into these other areas of the world, going into emerging markets, going into Europe or going into Asia. And it doesn't take much in terms of a down weighting of US, even if the US allocation was down weighted by just 5%, that is a huge amount of money that would then need to find its way into other areas of the market globally. And it can create all sorts of dislocations, as we've seen recently in terms of volatility. So if I look at the currency, this kind of tells a story of what's going on with the dollar. And first up, we've got the euro versus the dollar here. And what's been evident over the last couple of weeks is that the euro has suddenly strengthened very, very rapidly against the dollar. And if you have a look, it was down at about 102 at the start of this year. And all of a sudden, we're up at 113, 114 at the moment. And that also is after a huge technical break above a big resistance zone at 112. Now, what that's telling you is that the euro's become a whole lot stronger and the dollar's become a whole lot weaker. And in fact, the dollar has weakened by 10% just since January, really, even early February. That's a very, very big move for a currency the size of the dollar, and a currency pair as significant as the euro versus the dollar. That's a massive move. So the dollar's all of a sudden weakened quite dramatically. The euro has strengthened quite dramatically. And that's a reflection of the fact that money's been leaving the dollar and finding its way into other areas of the world, like the Eurozone, for example. If we look at it in a different way, this is the US dollar index. And what this is an index of the US dollar against six other developed world currencies. They made up of the euro, the pound, the yen, the Swiss franc, the Canadian dollar, and the Swedish krona. Those are the six countries currencies that are comprising the US dollar index. And the biggest by far and away is the dollar versus the euro pair. So that's the one that we watched a moment ago, and that's the biggest constituent in this dollar index over here. So if we look at the technicals here, this area around 100 is a significant level of support for the US dollar index. And what I look at technically here, and this is purely from a technical analysis theory point of view, when you get a trading range like this, which is what we've seen over the last 2.5 years, really, in the US dollar index, it's been bumbling up and down between 100 at the bottom and 107-ish at the top. And it's been up and down, sideways in that range. At the end of last year, 2024, that range was broken to the upside, but that's now turned out to be a false break, and the currency's come back inside. The dollar's weakened back inside that range. Now, from a technical analysis theory perspective, what you usually will find is when you get a false break to one side of the range, you usually find that it breaks in the opposite direction and then breaks out the other side of the range, because it's now suddenly got a whole lot of momentum on the way down here. So what we're watching for is the risk that this US dollar actually continues to weaken and ultimately breaks down below this 100 support level. And that could then open further downside for the dollar. And if we do see things carrying on the way they are, with Trump pushing ahead with these tariffs, the breakdown in confidence in the US, asset allocators globally looking to try and diversify out of the US and into other regions of the world, that could very well drive this US dollar dollar weaker still, and that would ultimately drive a breakdown below 100 on the US dollar index. So it's very, very important, and this is one of the key foundations of financial markets, really. So it's a very important instrument to watch this index. A couple of other things that I've picked up here, just in terms of confidence and sentiment, really, in the US particular. This is consumers bracing for inflation. There's surveys that are done on this all the time. And this is an interesting one. I mean, this chart goes all the way back to 1978, but it looks at consumer inflation expectations looking 1 year out, 12 months out. And what you can see all of a sudden is we've got this huge spike up in inflation expectations. We saw a pretty high levels of inflation in 2021, 22. After the pandemic, a lot of money was injected into the system. So we've all felt a bit of what that inflationary environment feels like. It's not great. But this chart is quite scary in the sense that it's saying what are consumer inflation expectations looking out in the next 12 months. Well, they're looking pretty dire. And this all goes around with the point around tariffs and raising the price of what would be imports into the US. Remember that the US is a net importer of various different things from all over the world, much of it from China, but obviously other parts of the world as well. And if Trump's going to push ahead with these tariffs, who's going to pay it? Well, it's going to be the consumer at the end of the day. And that's where this fear of higher inflation is coming in. So, and just keep in mind as well that this all feeds into generally a lack of confidence, which unfortunately has knock-on effects all the way down the chain, ultimately affecting profitability of businesses. This is on a similar vein, but something slightly different. It's consumers and their expectations for business confidence and business conditions. And right now, we've got a record high share of consumers worried that business confidence and business conditions are worsening. Looking 1 year out, nearly 70% of those surveyed are worried that business conditions are worse and will be worsening over the next year. And once again, these kind of things can become self-perpetuating. Unless Trump was to suddenly backtrack, which doesn't look likely, these weak confidence readings are quite concerning in terms of what consumers are likely to spend, what businesses are likely to do. It makes it very difficult if you're a business trying to plan for the future, trying to identify where to invest and what to do. If all of this suddenly seizes up, that's not good for the economy. It's not good for earnings growth at all. Then this is a chart that looks at household income expectations, also looking 1 year out, and what percentage do people expect their income to be higher or lower in a year's time. And you can see that historically, it's not unusual for people to expect their income to be 2 or 3% higher in a year from now, and that kind of has gone along with inflation over the time. But what we're seeing right now is that income expectations are right down. So consumers and people in the US essentially are worried that their earnings are going to decline or certainly not increase in the year ahead. So if you've got a situation where on the one hand, they're very worried about rising inflation, but on the other hand, they're also very worried that their income is not going to grow or even going to go lower, that's a big worry. People will tighten their belts in that situation, and it becomes a huge dent to confidence. And for that reason, it's why I'm saying I think that the equity markets probably remain bumpy and remain volatile. And I don't know that we're out of the woods yet in terms of this. So if we go back to this chart of the S&P 500 and the VIX that I spoke about previously, and what I said previously was that I think there's a fair probability that we could end up in some sort of a situation like 2022, where we may continue to dribble lower, and we're certainly not looking like we're going back into a bull market kind of an environment anytime soon. If at best we probably hold that 4,800 support level on the S&P 500 if we do go back down, and bumble around, in a broad volatile range. But I don't think that we've got the conditions now to see this market going back to an all-time high, not anytime soon from where I'm sitting, I don't think. So what to do? Well, a number of things. I've listed 5 points here that I think are worthwhile keeping in mind as we discuss this. And the first point is to understand that you should be a risk manager first. Capital protection is your number one priority as a trader and as an investor, and making profits is your second priority. In the courses that I run with people and the coaching that I do with people, I've often likened it to being a batsman at the crease in cricket. If you think about it, if you're a batsman at the crease, what's your number one priority? The number one priority is to protect your wicket, stay in, don't go out, right? And your second priority is to score some runs. You can't score the runs if you've lost your wicket and you've put your bat back under your arm and you're walking back to the pavilion. So remember that. Be a risk manager first. Protect your capital first, particularly in these very volatile and very unforgiving times in the market. And remember that profits come second. You will have opportunities to get involved, but the key is you need to protect your capital first in order to take advantage of opportunities that will inevitably come. Hedge your longer term exposure. Now, it might be a little bit late to make this suggestion, but it might not be. We are seeing a bit of a bounce in the market at the moment, and by the time you watch this, it may even be a little higher. It's possibly not too late, therefore, to put some hedges in place around your long-term portfolio if you are able to do that. Now, this can become a little bit complicated. It's not for everybody, but certainly what I've done with my own portfolio is I've actually created some options fences around the portfolio. Essentially got some put options which participate on the downside, and sold some very far out the money call options, which essentially become like covered calls, and I earn a bit of premium for the covered calls, and I use some of that money to then buy put options which protect the downside, in a very simplistic way of explaining it. If you are able to, then I would suggest hedging long-term exposure. So you keep your equity exposure, you hold it, but you protect the downside. Also, number 3, balance positions back to target weights. you should have an idea in your portfolio of what sort of percentage you want in individual stocks or individual ETFs, etc. And obviously, over time, these things fluctuate. So use this as an opportunity to balance back to your target weights. If you've got things that are doing very well, and you may be a little bit overexposed to certain areas, trim them back a little bit. But at the same time, keep some powder dry, which is number 4 here. Keep some powder dry for opportunities that will inevitably arise. And in terms of that, opportunities that will inevitably arise, build yourself a shopping list. Go out there and decide which stocks you particularly want to own. Maybe you identify some levels where you'd be interested to buy and keep those on your watch list. Maybe you leave some orders in the market to see whether those positions get filled. But keeping dry powder is important, because in this type of volatility, like we're seeing at the moment, it does throw up a lot of opportunities, and you want to be able to take advantage of those opportunities when they come around. And then the final point on the slide is don't panic. And it might be a little late to say that, because some might have already panicked. We certainly saw a huge amount of panic recently when the market pulled back as aggressively as it did. And that was what I spoke about with the VIX being so high. That reflected a lot of panic in the market. But at the end of the day, those who are able to keep a cool head when the markets become very tumultuous are often the ones that actually come out the strongest on the other side. Like I said earlier, bear markets separate the weak hands from their money effectively. And like the saying goes that I mentioned, in bear markets, shares return to their rightful owners. And that's kind of what we see in these types of hugely volatile situations. So you want to try and keep a cool head, try and be calm, don't panic. And if you've got dry powder and you've hedged your exposure, it puts you in a strong position to not panic when things get scary, but actually to be out there on the front foot and being able to identify opportunities, take advantage of them, and get involved. And if you've got that shopping list of stocks available and made it up for yourself so that you know where you're looking to go shopping, and you're ready, and you've got your dry powder and you're hedged, well, then you can actually come out very strong on the other side. So these types of situations, like we're seeing at the moment in the market, can be scary. I know that. I understand. I've been there. But I've also been through these cycles a couple of times in my career. And I also know that these are exciting times, because they are often the times when the best opportunities actually come around. And for a while, we haven't had a lot of deep value in terms of the US market particularly. There's not been much value to be had. Markets have been expensive. They've been richly priced. So the fact that we're getting a bit of a washout now and seeing some of this froth in the market being removed, it's probably a good thing ultimately. And seeing yourself out the other side of it, there's opportunities. There will be opportunities. They're coming, and you want to be able to take advantage of that. And the last point on this is just to remind you of the Oracle of Omaha. What's he been doing? Warren Buffett. He's sitting on probably the biggest cash pile that he's ever sat on in his Berkshire Hathaway investment holding business. He's a smart man. He's seen the storm clouds brewing. He's gone to a lot of cash, he's hedged exposure, and he's sitting pretty. And you'll find, like he always said, be greedy when others are fearful, and fearful when others are greedy. He was fearful when others were greedy. He was lightening up. He was taking a lot of profits off the table and building a huge cash buffer. He's now in a very strong position where he's going to be able to be greedy when others are fearful. And I'm sure that we'll start to see some news of Berkshire Hathaway doing some buying in the market in the months ahead. So that's all from me. I hope you found this helpful. It's something different for Talking with Traders this week, as I mentioned. But we'll be back with regular programming next week. We've got a couple of episodes left in this current season of Talking with Traders. But I thought this was something useful to share with you today, and I hope you found it helpful. Thanks for joining us for this week's episode of Talking with Traders, sponsored by IG, a world-leading CFD provider. We really are privileged to have such a strong global provider of online trading services as our backer for this podcast series. Remember to subscribe for more episodes by clicking on the subscribe button of your favorite podcast app, Or if you're watching on YouTube, please subscribe to our YouTube channel, give us a thumbs up, and leave a comment. We welcome the engagement. Till next time.